Welcome to Foss Company's Tax Credits Today podcast. We're glad to have you with us for a topic that is near and dear to my heart, the importance of tax insurance in tax credit transactions. My name is Kevin Haley. I'm the SVP of Investments at Foss Company, and I'm looking forward to a conversation with a couple of experts on this topic from Foss as well as from CAC Specialties Tax Insurance Practice. So I want to introduce Bryen Alperin from Foss, as well as Jordan and Yoni from CAC. Guys, I think it's probably best if you introduce yourselves. So maybe I'll hand it off to you, Jordan, to kick us off. Tell us who you are, what you do, and then we'll go over to Yoni and Bryen and jump into the discussion. Jordan?
So I'm Jordan Tamchin. I lead up the tax insurance practice at CAC Specialty. We are a specialty insurance brokerage that is now part of the Baldwin Group. Our team over here is the largest tax practice in North America that's made up of tax attorneys and former tax underwriters. And we sit in the intersection of tax law and the tax insurance markets. So we broker and advise on tax insurance placements across the full spectrum. So anything from M&A transactions, tax equity and tax credit transfers, ordinary course of tax positions, and other type of unique tax structuring. So our job is to take complex tax risk and translate it into something the insurance market could price and insure, and to get clients the best possible terms. I founded the tax practice at CAC and have been building it since 2019. And my colleague Yoni has been a key part of growing what we do in the energy and tax credit space specifically. So maybe I'll turn it over to Yoni to introduce himself.
Thanks, Jordan. I'm Yoni Tammam. I'm one of those 15 members of the tax insurance practice here at CAC. By way of background, I'm a former practicing tax attorney in firms like Kirkland & Ellis, Mayer Brown, and Reed Smith. And I got my start in the transactional insurance space about 4 years ago, leading both rep and warranty insurance placement and tax insurance placements at another national brokerage before coming over here to join the CAC team and focus solely on tax and line up with Jordan and help continue the growth of the product and continue to support tax credit monetization transactions with tax insurance.
All right. Bryen Alperin, pleasure to be on the podcast here with you guys. I am a partner and managing director at Foss Company. Been with Foss since 2017. I originally joined on the real estate part of our business doing historic rehabilitation tax credit transactions. But after a year or two, moved out to Denver and helped launch our renewable energy division, which we now call Energy and Infrastructure, and covers really all of the tax credits that came out of the Inflation Reduction Act. So we've done a lot of solar and battery storage, but we've also expanded into wind and fuel cells, clean fuels, RNG, microgrid, advanced manufacturing, kind of the entire alphabet soup of credits in the energy space. We typically, on the tax equity side of our business, will act as fund managers, and we will help large institutional investors deploy capital into these tax credit programs through our managed funds. With transferable credits, we sometimes will do that through the fund, or other times we'll act as a broker and direct transactions.
Great. Thanks, Bryen. This podcast today is really going to focus on one of the most important topics that we hear about from tax credit buyers and investors, and that is the management of risk. I think that as the market for energy tax credits has grown from something in the range of $20 billion a year of credit monetization pre-Inflation Reduction Act to now over $60 billion a year, a lot of these credits are being monetized by first-time investors who are learning about these credits. And one of the things that they inevitably run up against is the fact that there are risks involved in these deals. And as a tax practitioner or somebody on an investment team at a large corporation, managing that risk becomes very important as part of the transaction process. And so for our agenda today, I wanted to start with a brief overview of tax insurance. What is it? How does it work? How do you procure it? And why would you need it? And then we'll move into 3 focused discussions around some of the hottest topics in the tax credit and related insurance markets today, focusing on how tax insurance is used versus other risk mitigants. We'll talk about the state of the market. How available is this insurance? What are some of the pricing trends we're seeing? What are the types of covered tax positions that we're seeing? And then we'll wrap up with a discussion of what's changed in the last year since the passage of the One Big Beautiful Bill Act and what that's done to the tax credit market, how insurance is keeping up, and what we think might be coming next. So to kick things off, I want to start by handing it over to Jordan and Yoni to kind of set the table for this discussion. Why don't you guys give us a sense of what tax insurance is, just the 101, and why it gets applied in these transactions to begin with?
So tax insurance, it's a strategic and risk management tool that transfers the risk of a tax loss caused by a tax position being successfully challenged by a taxing authority away from the deal parties to the insurance market so the deal parties can execute a transaction with complete tax certainty. And so coverage typically includes any additional taxes owed, interest and penalties on those taxes, the cost of defending the position in an audit or litigation, as well as gross up because the receipt of the insurance proceeds may be taxable. So in practical terms, if you take a position, for example, claiming a credit or structuring a transaction, and the IRS, for example, later disagrees with that position, the tax insurance policy is intended to make you whole. So we like to compare tax insurance to getting a private letter ruling from the IRS on your tax positions. But instead of waiting for up to a year for the IRS to respond, and that's even assuming the IRS will even rule on the issue, you could get a tax insurance policy placed in as little as 2 weeks. And so at its core, it really converts uncertain tax risk into a known fixed cost, which is the premium, and it allows deals to close with complete confidence on both sides of the table.
One thing I'll quickly add there, Kevin, we talk a lot and you'll often see tax insurance come up in the transactional context, but we've also been seeing growth in the use of the product as clients consider using tax insurance to support their own balance sheets and not necessarily just dictated by a transaction, which has been a really nice growth in the product as well.
Thanks, Jordan, Yoni. Bryen, anything you want to add to that? Maybe some commentary on how we see investors choosing to apply tax insurance and the types of deals that we see insurance on?
Yeah, sure. So we've seen it shift over the years. When we were first launching a dedicated renewables fund, tax insurance was relatively rare and was more the exception. If there was some kind of a really unique situation, uncommon tax risk or uncertainty, you might see it. Or if there was a particularly weak guarantor and needed some additional credit support, it might be seen as a potential solution. But we were not utilizing it very much in those initial years. We slowly started seeing increased interest and utilization. In our funds, we started, especially for some of the, for example, step-up risks in tax equity transactions, utilizing it more often. I think really after the IRA in 2022 is where we saw a more significant shift where, because of the creation of transferable tax credits, there is many new buyers entering the market, some of them participating for the first time, and they were looking for some additional confidence in the credits they were purchasing. Also, as a transferable credit buyer, you don't have as many structural protections as you might as a tax equity investor, such as cash sweeps. So you're relying a bit more on the indemnities, the guarantee of the seller. And so tax insurance became, a pretty common backstop, if you will, for that. From our perspective, tax insurance has become an important part of these transactions and how we structure deals. Certainly, anytime we're going into a transaction where we expect we may be selling transferable credits, it's often a default requirement on these transactions.
I completely agree. As somebody who talks to a lot of corporate taxpayers going into one of these transactions, they pick up pretty quickly on the idea that there are going to be some risks they need to worry about. And tax insurance really has become, I like the word you used, Bryen, almost like a default tool or requirement for these transactions. And we talk to a lot of first-time transfer credit buyers, for example, who know that they have to go get this new credit idea approved by their leadership. And they're almost always asking us to make sure they have a complete understanding of the risk management and what the insurance policies are going to cover before they even have that conversation with the CFO. So we view this as really foundational to success in the tax credit world. I think one other foundational question we should answer here at the beginning is how this insurance gets procured, because we talk to a lot of buyers who know that they want the insurance, but they don't necessarily know how it works and how they get it. And so maybe, Yoni, could you walk us through the steps that you typically see in the market when a new insurance policy is being required and has to get placed? I imagine step number one is calling CAC, but maybe you could enlighten us on steps 2 through 5.
It's actually a more streamlined process than more people would expect. To take a step back, I think it's important to understand the process, to understand the players. Generally, we have the insured and the stakeholders of the transaction. We have a tax insurance broker like ourselves here at CAC, and we have the underwriters. Alongside those parties is going to be the stakeholders and their counsel and underwriters counsel along the way. So the first step is a risk is identified for which a solution is needed. In the case of tax credits, oftentimes when we're talking about ITCs, right, that's valuation, recapture, qualification, different things like that. Particularly when you're talking in the transfer context, as you guys alluded to before, buyers are generally looking for what we'll call full wrap policies. And so once a buyer or investor has made an identification as tax credit insurance as an indemnity package here, the stakeholders will reach out to a broker like us, and that's where we come in. And what we'll do is we'll work with the clients and their advisors to get an understanding of the risk profile, the project, the transaction, the purpose behind the insurance, any sort of specificity that's needed to facilitate the transaction. That will include reviewing underlying support. One of the things we say about the diligence process in the transactional insurance underwriting space is they diligence the diligence. So the diligence package that you're oftentimes looking to procure for underwriters in order to obtain a quote is very similar to the diligence package that a seller of tax credits or developer would be looking to put together for a buyer or tax equity investor. We'll review those documents and with deliverables, provide any feedback, discuss strategy points with the client to make sure that we have a clear picture of the submission of the risk and ultimately the submission process. We'll then take those materials and go out to the insurance market. There's about 32 different underwriters in the tax insurance market right now. So we'll go out and market the risk to those 32 underwriters and generate competition, negotiate the terms with them. One of the things we pride ourselves here at CAC is we are price makers, not price takers. That's due to the fact we have a team big enough to get on the phone and call everybody and work with the underwriters to discuss any of the particularities and obtain quotes. Once we obtain those quotes, we'll review, provide any feedback, potentially push back on some of the requests and conditions that the underwriters are providing, and discuss with the client to determine which underwriter is the best to select as the primary underwriter for their risk. Once we've negotiated those terms, what's often called a non-binding indication letter, an NBIL, the client will select an underwriter to engage and will commence underwriting. That underwriting process generally takes 3-ish weeks, give or take, and that will include the underwriter both underwriting the risk by reviewing memos, opinions, and cost segs, appraisals, whatever deliverables really relate to the risk. If it's a 45X deal, that's going to be different than a 4080 deal. And negotiate the policy in tandem. Once we've done that and we've negotiated the policy and underwritten the risk, we can work to get the policy bound and then later issued. The underwriting process right now, the few main sensitivities that you're seeing in the market are really tied to valuation risk and recapture risk. And as of course, we'll talk in more detail later, FEOC is an item that right now is causing some consternation in the market. As far as the rest of the process to finish, that really is payment. Once you've bound the policy and any other forms and deliverables that need to be delivered after binding, one thing that we often get from first-time users of tax insurance is questions about that premium. It's not an annual premium like other insurance policies. That premium is a one-time upfront cost, no ongoing payments. And it's often structured as a shared cost between the buyer and the seller in a credit transfer deal. And who bears the cost is often a point of negotiation depending on the transaction dynamics.
That's a great overview. And I think one of the important points I'll add is that a lot of times the buyer or the investor in the credit will have opportunities to weigh in on these policies. And I think that's a little bit of a shift we've seen in the transaction process over time, whereby a lot of times project sponsors will have some sense of the policy that they want to procure for the credit transaction, but increasingly we're seeing the policy wait to be bound until the buyer or investor has a chance to weigh in. And that oftentimes helps make sure that the coverage fits the particular areas of emphasis that the buyer's sensitive to.
It's a really good point, Kevin. I think part of the process that I glossed over was the policy negotiation point. But part of the reason tax insurance has taken off and has been used as heavily as it has been is because these policies are highly bespoke and negotiable, unlike other forms of insurance. And buyers of tax credits have really appreciated the ability to have a very clear negotiated policy, because one of the jobs that we do as broker is we want to make sure that in the event of a claim, there are no questions as to whether or not it is covered by the policy. And that involves carefully crafting the language of these policies. And that's part of where our team really leans on some of our technical backgrounds and experience to help guide those negotiations.
Yeah, and we'll get into some more of the details on the covered positions themselves and what's changed post-OBBB. But before we go there, I want to bring up a topic that I think is very relevant as we discuss the importance of insurance, the importance of risk management, and that's how insurance plays a role in risk management relative to the other options out there. And I think one of the other primary risk mitigants that we tend to hear a lot about and see in some of our transactions is this idea of a sponsor guarantee. And so if you're going to be facing some risk in these deals, the insurance policy can certainly work to shift that risk, as Jordan outlined earlier. But in some instances, we see the seller of the credits, the project sponsor, also offering a financial guarantee. And so, Jordan, I want to start with you, and I'd love for you to frame up how these two risk mitigants can work together in some instances, and in some instances, possibly be substitutes to one another. And then we'll go from there. Bryen, I'd love to get your thoughts as well from more of a broader transaction lens, how you view these different risk mitigants. But Jordan, I want to hand it over to you to talk about the difference between insurance and guarantees and how you think about the two.
Thanks, Kevin. I agree with you. I think this is probably one of the most important conversations that you're probably having with your clients in deal structuring right now. So an investment grade backed guarantee is exactly what it sounds like. It's a contractual promise from an investment grade rated entity, which is, as you mentioned, a corporate parent or a financial institution. And it's intended to cover the investor loss if there's a tax credit recapture or a disallowance of the tax credit. On the other hand, tax insurance, it's a third-party insurance policy issued by an A-rated insurer that provides the same economic protection, but the counterparty is the insurance market rather than a specific corporate entity. So the key structural difference is that a guarantee is really only as good as the guarantor's creditworthiness and, more importantly, their willingness to pay. An insurance policy is backed by regulated, A-rated insurers with defined claims obligations and a legal duty to perform. Insurers, particularly those in the transactional liability market, they're in the business of paying claims, while guarantors are not. So it may be a little bit more difficult to actually get paid under an investment grade backed guarantee as opposed to an insurance policy. I think a guarantee also creates an ongoing contingent liability on the guarantor's balance sheet, which has a cost to the guarantor that often gets priced into the deal, while insurance removes that from the guarantor's balance sheet entirely. From a risk transfer standpoint, I think a well-structured insurance and a strong investment-grade guarantee can provide similar economic outcomes, but as I mentioned, they're quite different.
Thanks, Jordan. Bryen, what are your thoughts on this topic, particularly because we see both in the transactions we work on? We have investors who sometimes come to us with preferences. When you're leading an underwriting exercise on a deal, do you think about the two primary risk mitigants differently? Do you act differently when evaluating a deal? Help us understand a little bit more from the broader transaction sense what a guarantee means versus insurance on these transactions.
I tend to look at this through the lens of a commercial banker. This is how I started my career, but that's also many of the tax equity investors in our space are banks, and many of them run it through their credit committees. So, I think it's a view that much of the market takes in how they assess these deals. And I would start by saying guarantees are not always easily collected, as Jordan alluded to. I started my career, was sort of handed a special assets portfolio of a bunch of loans that the bank had written off that were in bankruptcy or otherwise behind on payments, and the bank was trying to collect on guarantees and those types of things. And, it was often pennies on the dollar that they were able to recover. Obviously, if you have an IG guarantee, it's a stronger entity standing behind that guarantee. But how long is it going to take to collect? How much is it going to cost to collect? And we also, when we're underwriting these guarantees, we do what we call a contingent liability analysis, where we look at not just the tax risk that they may be providing a backstop to on our transaction, but what are all of the other transactions they've done that may have similar tax risks? Because if the IRS came in and adjusted our deal, they might be adjusting others. And could they absorb an adjustment to their entire portfolio in, for example, a disallowance of step-ups or adders, something like that? So we are assessing the guarantor's balance sheet relative to some of those types of liabilities that aren't just visible on the balance sheet. And through that analysis, sometimes we might determine that even though they've got billions of dollars of equity, they also have billions of dollars of contingent liabilities. And we would like to see a tax insurance policy that is further supporting that credit support. So I think we've overall seen the market become more and more comfortable with these tax insurance policies. I think in the early days, sometimes the attitude was a bit like, if I wouldn't do the deal without the tax insurance, I just shouldn't do it. And, I'm not going to use that to try to gloss over these risks that I really just should be avoiding altogether. But I think the market has evolved and understood that there are some of these kind of pinhole risks that it makes sense to address with insurance. And there's fortunately not on NAR deals, but there have been, payouts in the market, and folks have gotten comfortable that, there is value with these tax insurance policies. So we do see tax insurance being utilized quite a bit, especially in cases where the guarantor is not quite as strong, or sometimes we see deals where it's a private equity backed entity and the parent private equity firm is not willing to provide a guarantee. Those types of situations, tax insurance can help be a credit support tool to kind of further back the indemnities that the sponsor would be otherwise giving. And like I mentioned as well, in these hybrid transactions where we're selling tax credits, many times the buyers are expecting there to be a tax insurance policy on the transferred credits. So we're utilizing them heavily on those. And yes, I'd agree with Jordan. It's helpful that these are pretty customizable. So we have these conversations with our investors on the menu of options. And in some cases, they may want more or less coverage on certain areas or have certain specific items that they want to make sure are covered. And we can build those into sort of the investment criteria of our funds.
Great. Thanks, Bryen. Yoni, Jordan, any reaction to that, thoughts?
One thing Bryen touched on at the end that I want to emphasize is claims get paid in this space. And to the point, underwriters will boast about how much claims they've paid. One of our primary trading partners boasts, even in their signature line, that they've paid over $1 billion in claims in the transactional space. And to give an idea on why that is, it needs to happen in order for the product to work and in order for it to continue to go, because that's why counterparties are demanding the use of it as a good indemnity, because they trust that it will pay out when that time comes.
Yeah, that's a great point. And we get a lot of questions about that. Do these policies ever get paid? And I think it's helpful to be able to point to a track record there. We'll get into this a little bit more on the FEOC discussion and the post-OBBB world in a couple of minutes. But I do just want to maybe point out that I think sometimes these indemnities or the financial guarantees that are being offered by sponsors or sellers, they're oftentimes described as entirely comprehensive. They cover every risk. I mean, Yoni, do you agree with that? And there's certainly going to be some things the insurance market won't be willing to take on, whether it's a specific tax position or it's a specific risk, or maybe they're just going to price it in such a way that it doesn't become economically viable to actually take insurance on. How do you think about that particular conundrum whereby you might have some of these, like Bryen said earlier, some of these pinhole risks that maybe one product versus the other is better at covering?
Yeah, I think part of what has made tax insurance so successful, and we touched upon this in talking about policy negotiations, is the policy is geared towards defined specific risks and is tailored and heavily negotiated to make sure that all the parties know what is and is not covered very clearly. And different carriers now have different appetites for the projects and risks that they're willing to cover and or the terms and conditions around that. One of the things we really try and focus on is making sure every deal gets a quote, be it the economics might look a little different than for an atypical deal than a typical deal, but we have taken 99% of our submissions to binding. The other thing is that you have is, even though there might be some sort of area that isn't covered in the insurance policy, you're going in with eyes open as to that not being covered. The parties can then decide if they need to otherwise contractually indemnify for that risk that isn't covered. So I think the difference really there between the guarantee and the indemnity and the insurance policy in terms of scope is, one could argue that a guarantee is broader, but it could also just leave more room for argument and interpretation, and can come at a cost also to that guarantor on the flip side of it. We're talking here mostly as buyers and thinking about why that guarantee doesn't offer them necessarily the same level of protection. But a guarantor who might think, I'm not giving an indemnity for anything broader than a tax insurance policy, may actually end up having given an indemnity broader than a tax insurance policy. Another area, and Jordan touched upon this, but where the insurance has a meaningful edge, is the insurance policy is a regulated financial instrument with a legal duty to pay valid claims. Guarantee depends on the guarantor's willingness and ability to honor it. And I think there's been a few, call it high-profile bankruptcies in this space that would make me, as a buyer of tax credits or a tax equity investor, potentially think again or reconsider the strength of the guarantee or the ability to collect on that guarantee as compared to insurance highly regulated and rated paper. What an investor should really look for in a policy is make sure that the coverage triggers are clearly defined, that they match the actual risk, and check the process and procedures and the insurer's track record. We have worked with our clients before signing NBILs or binding policies to make sure that they are comfortable with the insurance paper that is on the policy. Since sometimes there are NGUs, MGAs who work for a consortium of insurers, they may have multiple insurers on covering their commitment. And our clients are able to look and see and make sure they are comfortable with that. And additionally, you want to confirm that a policy period aligns with the relevant statute of limitations. One of the reasons that drove the procurement of tax insurance generally in this space is due to those long tail with this risk. Oftentimes, the financing or the transaction for which tax insurance is being placed is happening 12 months before the project's even placed in service or the credits are generated. And then you have another year after that until you file your tax return. And then you have years after that for the IRS or government to pick it up on audit and make a challenge. So that's the other thing to be thinking about when assessing a guarantee versus an insurance policy is you're comfortable with it now, but will you be comfortable with it in 7 years?
Yeah, I was just going to add, we see lots of kind of games get played in how these guarantees are structured. And you reminded me of a common one we see where they might say, hey, the investment tax credit has a 5-year compliance period. So the cap on our guarantee is going to reduce every year, essentially phase out over 5 years, 20% a year. But the reality being some of these tax risks don't step down. And so if you had let's say an audit in year 3 and it's a disqualification of an adder or step up or something, it would be on the full amount. And if you allowed your guarantee to step down pro rata with that ITC compliance period, you might not have sufficient coverage. We see a lot of little things like that get built in and negotiated in these documents. And I think to your point is a good one that, sometimes it might look like the tax insurance has more exceptions because they're very explicit and list them all. But I think with the guarantees, there's sometimes not necessarily as many exceptions that are explicit, but there are perhaps areas of ambiguity or traps that you could fall into if you haven't done a good job negotiating it.
Bryen, that point about the step down in the indemnity amount is a significant issue that I see in some guarantees, particularly when, as mentioned, that you have these long tail contingent exposures. So you may not get audited for 3 years and the issue may not be resolved for many years after that. And so you may be dealing with a tax exposure greater than your guarantee after it steps down.
And the one other area, Kevin, we talked about what it would look like for the guarantor, for the benefitor of the guarantor, the guarantee. The sponsor also could have significant financial impacts, developer sponsor, if that guarantee needs to be called upon. And I think sometimes it's a little bit looking just at the now and in the present when making this assessment as to what route to go on, and not necessarily thinking about what happens if something goes wrong, but more this can help get the deal over the line. And we always say we don't just sell paper, so we make sure that these policies are structured and negotiated in such a way that the claims process is smooth and clear.
And one thing I was going to add as well is we had actually a conversation about this with an investor today in terms of the exposure to a single guarantor versus exposure to a tax insurance policy, and the fact that many times these tax insurance policies are built with through a stack of different insurers. So you have some diversification within that. If you're doing multiple deals every year, you're not building up a massive liability or exposure to one insurer necessarily.
I think that's a really good synopsis of some of the different factors that certainly investors and buyers, and maybe even to some extent, as you point out, sponsors or sellers need to take into account. And we've even heard this from some of the money center banks that have the ability to write really strong guarantees, but also recognize that that is not an unlimited commodity that they can offer. And so, we talk to some of those really large financial institutions. They'll be upfront with us about the fact that they can't write unlimited guarantees. And so I think you've done a great job of summarizing some of the differences and where the benefits may lie with one versus the other. I think it's a good time to pivot over and talk a little bit about the state of the insurance market. And Jordan, I want to start with you to get your thoughts on the market right now. You guys see so much of it. You pointed out earlier, 30 plus underwriters are now in the space. Talk to us a little bit about the market, pricing, different trends you see in the covered tax positions, and then we'll talk more specifically about OB3 after that.
Sure. So the market overall is active and it's competitive, but you are seeing some tightening in areas. I think in 2023, there was an exuberance and the tax insurance market swung very far in one direction to really provide all types of solutions to sponsors, investors, all constituents that are part of either tax equity or transferability transaction. And what you start to see in 2025 and into 2026 is a rebalancing, I would say, of risk appetite, but where the tax insurance market wants to be. And so you're starting to see a redefinement of what tax credit insurance is and what risks underwriters are willing to take on in this market. And so overall, as I mentioned, from a capacity perspective, Yoni mentioned there's over 30 active underwriters in the market. There's a little bit more than $1 billion of total capacity for any single policy. We're actually seeing that continue to grow. I think we hit a bottom in the beginning of 2025 where I would have said it was about 750 to 800 million of capacity. But since then, we've seen new markets enter. We've also saw old markets that were on the sideline re-enter the market. And a lot of that had to do with underwriters moving from one underwriting shop to another. And really for anything that's like a clean, well-documented risk, there's a lot of competition and that's still driving down pricing and you're getting better terms for that. But from an overall perspective, the underwriter's bandwidth is pretty stretched. You're seeing a rush to get deals closed before OB3's FEOC deadlines, which has really created a volume surge. And so underwriters are working through a significant backlog. And so if you look at how submissions used to be compared to where they are today, we're no longer in the days where a broker just simply sends an email out to the markets and expect to receive proposals within 2 to 3 business days. That's not the market anymore. Brokers are working harder. And so I think that's one of the things that has separated CAC from others is that we have the bandwidth and the team to reach out to each of those markets to drive up competition, educate the underwriters of the underlying risk transfer, and help them get comfortable with preparing that proposal. If you're simply going to wait to get proposals from the market, you're simply not going to get them. There's just way too many deals out there. And so if there's any hair on it whatsoever, unless you're trying to lean into your market relationships and get terms, if you're passive about it, you're going to be doing a disservice for your clients. From a pricing perspective, we have seen pricing move modestly upward from their historic lows in 23 and 24. A part of that has to do with supply and demand. We're talking about a large surge in demand for the product, but part of that also has to do with claims being paid. There have been a number of claims related to renewable energy tax credits that have been paid out, some of which were paid out arising from settlements. Some of them are payouts related to just the contest costs. And so pricing has reflected that. As far as underwriting appetite, it really varies depending on the credit. But we're also seeing interest in credits that formerly there was no interest. So we're seeing a lot of placements for 45Z and 45Q. There's a huge interest in the market for 45X and any other type of PTCs. When it comes to the investment tax credit, it really depends on the underlying facts of the project. And so you start thinking of things like concentric circles, where you have some markets that are okay with higher step ups. You have some markets that are okay with recapture under Section 50. And you have some markets that are okay with domestic content. You have some markets that are okay with energy community or brownfield adders. And so you have to kind of narrow that down into which markets are okay with all of them. And so because of all the potential qualification risks related to it, sometimes you're not going to find a wide range of markets that are really interested in a particular project. But again, that's up to the broker to really call on their market relationships, reach out to the underwriters, have that dialogue, and get them interested in the other underlying project and provide terms. But once you really have a primary market involved, and assuming diligence is going well, we're able to complete insurance programs on all of our transactions. Again, I mentioned that there's about $1 to $1.1 billion of total capacity in the market for a single transaction. That being said, we recently did a project that required $1.4 billion. Well, that the project generated $1.4 billion of ITCs, and we came up with what I will say is a clever two-policy structure in order to satisfy the requirements of all constituents to the transaction, including tax equity, lenders, and tax credit buyers. So it really comes down to creative thinking in this market, as well as rolling up your sleeves and doing the work, because there is a huge demand for the product, and we are seeing some bandwidth constraints from the underwriters.
Great, Jordan. Thanks for that overview. Obviously, it's a dynamic market. I mean, I think you've done a good job kind of hitting some of the points that we see show up in the transactions. And certainly the price movement is something that we're conscious of. A lot of times that's a cost borne by the sellers, but it still affects where the ultimate tax credit pricing shakes out. And, I think we're going to keep a close eye on how the market continues to evolve. But I'm encouraged by the fact that you highlighted that even individual policies are growing in size and that there are more underwriters and more markets active in the space. Yoni, any other thoughts on the state of the market from you or from you, Bryen?
One thing I think we're starting to see an uptick in, and this ties to OB3, is more emphasis on begun construction specific coverage, policy scope specifically to the risk. And the interesting thing about that is being asked to procure that coverage earlier in the project financing timeline, given the FEOC and other tax credit related risks that turn on begun construction, not just amount of tax credit, but full on eligibility. The market has been and is continuing to cover prevailing wage and apprenticeship requirements. How that looks is changing, and it's something I think clients should focus on with their brokers and make sure their broker walks them through what the coverage scope is there. We are still seeing robust demand for bonus adder coverage, like domestic content bonus and energy community adders. Each of those carry their own qualification risk. Even energy community adders, where you're pointing to the map, may not be as straightforward as one might think. And interestingly, we've actually recently been seeing a major uptick in requests for brownfield determination, particularly as standalone policies. We're actually even seeing the use of tax insurance, as I mentioned earlier, in the financing, but at the M&A stage to support specific tax risks that are being identified at the M&A stage when it's not greenfield development. Another area that I think is just keen to be aware of for developers in particular is, in the past, we had oftentimes the strategy would be to look for portfolio level policies, particularly in the community solar and DG space, where you can achieve economies of scale for pricing. However, due to the increase in demand, we've seen carriers' appetite for portfolios shrink. And if you're looking at a portfolio of greater than 5 projects, particularly if you're not in the residential space, we very much encourage consulting early on with your broker on how to best position your portfolio to obtain coverage. Interestingly, the reason behind the shrinking appetite isn't necessarily tied to the overall risk assessment on a portfolio, but rather the opportunity cost. Because let's say it's 10 projects that make up $200 million of tax credits in the portfolio. The underwriter still needs to underwrite 10 specific projects for the premium associated with that $200 million of tax credits, which can theoretically take 10 times as long as it would take for that underwriter to underwrite one asset that would generate 200 million of tax credits and the same level of premium. And one thing that we'll talk about more when we talk in the OB3, but it's worth noting that FEOC coverage right now is still an evolving landscape in the tax insurance market. I would say that until more guidance comes out, the underwriting market has yet to coalesce around what is and isn't going to be market FEOC coverage. And so, again, the importance of consulting with your broker early if FEOC is going to be at play is important. And the relationships are important to lean on with the underwriters, because one thing we're hearing from underwriters is a reluctancy to just say, send over your memo and opinion and we'll give you a look, because they know that without guidance, there might be some memos or opinions that are lacking in analysis or are heavily reliant on assumptions. And so a broker's role in the FEOC world is growing, because we are also that first line of review to make sure that a memo or opinion is in good enough shape, or qualified enough, I would say at times, to get to the eyes of the underwriter to begin a conversation around FEOC coverage.
Two other things I think just worth mentioning that I think is just helpful overall is, one, we strongly recommend to be brought in earlier in the deal, sometimes at the term sheet phase, either with a tax credit buyer or tax equity investor or pref equity investor when you're negotiating the term sheet, just to make sure that the insurance requirements being asked of the counterparties are within market and you're able to provide coverage for that. One of those, as you mentioned, FEOC, right? Until we have more guidance out related to certain FEOC issues, I don't want sponsors to overpromise what is or is not available in the marketplace. One of the other things that we have great insight into is how much insurance is being asked in the marketplace, whether it's a portion of the ITCs, 100% of the ITCs, or some 100+% of the ITCs. We could offer guidance there. So bringing us in earlier in the process has been helpful, including for, as Yoni mentioned, reviewing some of the underlying documentation that will be provided to the underwriters so that the sponsors and the attorneys could get at least the benefit of our eyes, because we see a lot of other types of underwriting material, memos and opinions in the marketplace. The other thing that I think is worth mentioning is, from our learnings of the M&A boom in 2021, as well as the surge of demand for tax credit insurance in Q4 of last year, if you think that you're going to need a tax insurance policy bound in Q4, our recommendation is to get to the market as early as possible in Q3. Once you get into Thanksgiving area and you're first asking to go to market with the submission, it is going to be extremely difficult to get quality terms. And so you're going to see surge pricing, and it's going to be hard to even get underwriters to take a look at some of the submissions. So our strong recommendation is to start thinking in advance and start preparing if you think you're going to need a tax insurance policy bound in Q4, where the broker should be going out to get terms, in Q3.
Thanks, Jordan. Glad you touched on the seasonality component there too. I was going to ask about that. And we see a lot of deals in Q4, as you know. So that's advice I think all parties should take to heart. It's a great segue into the OB3 discussion, which we've left to the end here because I know that's what everybody really wants to talk about. And so maybe the best way to tackle this is, Bryen, I'd love for you to set up the kind of landscape for us here post One Big Beautiful Bill Act. Can you give us a just quick synopsis of what the bill did to the tax credit landscape and what some of the shifting risks look like today for both the generators of the credits and the buyers of the credits? And then Jordan, would love you to chime in with how the tax insurance market is processing those changes. So, Bryen?
Yeah, sure. Happy to give an overview. So, the One Big Beautiful Bill, it was not sort of the worst case scenario that perhaps the industry feared for a time. We did not see a full repeal of these clean energy tax credits. We did not see retroactive removal of credits or anything like that. Many of the credits survived relatively unharmed. The solar and wind credits, for example, had their phase out accelerated, though, if you look at the kind of longer term historical perspective of solar and wind, they have been a few years away from phasing out for most of their existence. So less than ideal, but I think it was a workable kind of framework that developers were able to move forward and go through. There's a lot of experience in the market because of all those prior phase outs in terms of how to safe harbor projects and establish begun construction, how to get the legal opinions and the tax insurance for those types of things. So a lot of that activity was able to occur very quickly. The FEOC aspect of OB3 was one that was a bit new, and I think it's very complicated. There's different aspects to it. The first year in 2025, when I was going to conferences, I felt like most developers either were saying, I don't need to worry about it because I'm just going to safe harbor my projects and it won't apply to me. Or if they were dealing with it, they were maybe just dealing with a small subset of the requirements. I think by 2026, folks started to realize, even if I started construction in 2025 and safe harbored my project, I still am impacted by some aspects of FEOC and I'd have to work through this. So the market is, I think, woken up to it and has started to grapple with some of these questions. There are pieces of it that are easier to address than others. But, I would say we've seen some participants just step to the sidelines or say we're only going to do what we refer to as legacy tax credits, those that started construction in 2024 and have no FEOC exposure whatsoever. But we have also seen a lot of, especially our more experienced investors, forging forward and navigating. There still are maybe particular transactions where they can't get comfortable with the facts and circumstances, but we are seeing deals get done. And I think that's interesting that in some cases, perhaps they're getting comfortable faster than the tax insurers on some of these issues. But, they do also have, depending on the transaction, many times multiple layers of protection. So like in a tax equity deal, for example, we have our cash sweeps where we're often able to sweep cash flow, even senior to the debt service. We also have the guarantees that protect us. And then, we may be seeking out additional sort of structural mitigants specific to the FEOC, like additional guarantors or things like that are, just for the FEOC exposure to the extent tax insurance isn't available yet. And we have seen, I guess I'd say some very ad hoc kind of custom tax insurance in some cases, but yeah, it seems like it's not yet kind of standardized, fully available. Jordan, you guys can let me know if you disagree, but I think there's probably some aspects of FEOC that just don't lend themselves well to tax insurance ever because they're more sort of a voluntary action that would be a violation. And you're probably not going to get insurance for having taken some voluntary action that caused a recapture. So there's going to be some amount of risk there that market needs to get comfortable with. I think for us, a big part of that is just making sure we do a really solid job on the front end with the diligence, bringing in third parties like Big Four accounting firms to assist with some of the diligence that can be a pretty heavy lift, and then getting tax opinions on top of that. and then working with the counterparties to get strong indemnities from our sponsor partners. And we underwrite the strength of those indemnities and the cash flows, et cetera, relative to the risk level.
Thanks, Bryen. Jordan, let's turn to you. That was a pretty good overview of OB3 and the fact that it did introduce some net new risks to these tax credit deals. How is the insurance market covering that? And what are some of the outstanding questions that perhaps the industry is still working through at this point?
Sure. So I think the easiest one was as a result of the early termination of the 45Y and 48E credits. There's a big focus on beginning of construction. That has always been something that the insurance market has been able to provide coverage for. Post-OBBB, we started to see some new and creative ways to satisfy physical work. So we saw some new FEOC strategies that have been insured in the marketplace. And as was mentioned, a few times already, this is now something common that we're seeing in coverage, particularly for purposes of establishing that you begun construction prior to either 25 or in 25 to either be out of FEOC or have limited FEOC requirements so that the material assistance rules don't apply. Then stepping into the world of FEOC, it really has created some tension in the tax insurance market. I think the guidance that came out as it relates to material assistance has been quite helpful. That said, we're not really operating in a world where material assistance rules apply yet. So you don't see a lot of projects that begun construction in 2026, other than with respect to potentially resi solar or maybe some smaller DG assets. But most of the deals that we're working on are either beginning of construction in 24 still or BOC'd in 2025. So you have to deal with the FIE SFP rules for FEOC. And so we are running into certain situations for a lot of our sponsor clients where they BOC'd a project in 2025 and now the project's about to go online. And so for those projects, we've come up with some creative tax insurance policies that helped facilitate deals get done, which has been a real big win for our clients, and the tax insurance market has stepped up. These policies are acting like the old type of policies that you might have heard about with like a double trigger type policy or other type of structuring mechanisms where the sponsor is actually taking a first loss position for the insurers. But as a result of that structuring, it's helping to facilitate the flow of capital. We know that the underwriters do want to start looking harder at FEOC positions related to FIE SFE rules. We are starting to see more opinions from law firms on these issues. And we're hoping that the market does start taking a deeper dive into those opinions and start providing coverage. But even if they're not providing coverage now, one of the key takeaways that we at CAC are doing on behalf of our sponsors is that I think it's prudent to build a roadmap, whether it's in the proposal or and eventually the policy or in the binder, about what happens if FEOC guidance comes out. Because what you don't want is to bind a policy and there's no roadmap at all. So when guidance comes out and the client asks us to get coverage, the insurer just says, we already bound the policy. We're not interested in adding coverage for FEOC under the policy. That we really have a roadmap of how to add that coverage when FEOC guidance comes out. So what I mean by that is, what are the rules of the land so that the insurer will provide coverage? And so generally that will require guidance coming out, the insured providing should level advice, whether it's an opinion or memo to the insurer using reasonable best efforts or some reasonableness standard to get comfortable with such guidance, and then also triangulating what the additional premium and underwriting fees would be so that all parties kind of know the lay of the land once guidance comes out. So I think that's critical. Moving away from FEOC, I think one of the things that we should celebrate is that transferability was retained. And so Section 6418 survived, and that's been really, really positive for the tax credit market for sponsors to help monetize these tax credits. And so that has really made sure that the tax credit transfer ecosystem continues to function. So that's really been a positive development. What OB3 really didn't change was the purpose for tax insurance. Tax insurance has actually become more relevant to help facilitate transactions as a result of OB3. OB3, I think, opened the door for 45X and 45Z and 45Q and other types of credits, as well as the survival of certain credits like nuclear. So you're really going to see a long horizon for other types of credits that are going to be insured in the marketplace and also that can be transferred. And one of the great things about the tax insurance market, having been involved in this industry first as an underwriter and now as a broker for over a decade now, is that the product is adaptable and the market is willing to adapt and try to provide a solution to help facilitate deals get done. And that's why it's quite exciting time right now for the market. And while we know that there is some pause right now related to FEOC, I think what everyone should be excited about is that once more guidance comes out related to it, that the insurance market will be able to respond. That said, as Bryen mentioned, there probably are aspects of it that is not going to be coverable, but that's no different than other things like, as Bryen mentioned, anything that is a voluntary type of action by the insured that causes recapture. But overall, I think it's a net positive.
Thanks, Jordan. That's a great overview of how the market is tackling these challenges. And I think your point's very well taken. It's an adaptable product. We've seen that over and over again in the past. We saw that in the transition from the pure tax equity landscape prior to the Inflation Reduction Act to now the massive growth of the transferability market. And even since the transferability market's grown, we've seen that adaptability throughout the policies and the broader market. So I think that'll continue here with FEOC and post-OB3 implications. It's a great place to leave the conversation for today. I want to give each of you the final word here in terms of what you see coming next for the market, for the industry, for the product. Any thoughts about what's going to come to light in the back half of 2026 and into next year?
I'm really hopeful we get actionable FEOC guidance. And once we do, I fully expect the insurance market to jump in. I think we are also going to start seeing some of the first audits coming out of the Inflation Reduction Act projects, and how that will inform the insurance market will be interesting. But from where I stand overall, tax insurance market has proven itself to be adaptive and resilient. Every time the legislative or regulatory landscape has shifted, the product has evolved to meet the new risks, not just the tax credit related risks as well. And I don't expect that to change. To just quickly touch on a little bit of the hesitancy, I think, from some of our insurers, it's not that they don't want to cover FEOC. It's that they want guidance to make sure they're covering it right. Tax insurance is viewed by the government as a means of supporting reasonable taxpayers. And that's what our underwriters are just making sure they're looking to do. And so I fully expect the market to continue to grow, continue to evolve, and transactions, even with FEOC concerns, to still be getting done.
Thanks, Yoni. Jordan, any hot predictions for the foreseeable future?
I think the one thing that I'm going to be highly focused on as a broker is one, what's the underlying capacity in the market? And two, what's the bandwidth of our underwriters? If deal volume stays high through the end of this year, underwriter bandwidth will probably remain a constraint. And so we are continuing to tell our underwriters to hire more people. I think that is really important so that we could meet the demand surge for the product. The other thing is capacity. We're seeing bigger and bigger deals, and we expect that trend to continue. And in order to help make sure that tax credits from those larger transactions can trade, tax insurance is going to play a really important role. And so, yes, we could do creative structuring around it to help solve for that, but we would like to see, continued capacity and new entrants in the market. I think that's also healthy to continue to grow competition. Competition is always healthy for our clients because it results in better terms and better pricing for our clients. So that's something I'm definitely going to keep an eye on for the rest of the year.
Awesome. Thanks, Jordan. And Bryen, I'll give you the final word. When you look into your crystal ball, what do you see coming down the line for the industry?
Well, after the IRA, the energy tax credit market grew rapidly just in terms of the annual number of tax credits transacting in the market. And, the tax equity availability did not grow at that same rate. So a lot of that gap was made up through these, hybrid transactions or transferable tax credit transactions. In some cases, they are not, the most optimal from a finance perspective. You might, for example, not be fully monetizing the depreciation in some of these transactions. And so, I think long-term for the industry, we're hopeful that more of these investors that have just started to get involved, either perhaps they've got a couple of years of purchasing transferable credits under their belt now, or they're starting to venture into some different types of credits, but still in the transferable space, we are starting to see more of them also consider tax equity. And, Foss, we spent a lot of our time trying to educate investors, both first-time participants, they're just getting involved in transfer credits, but then also helping them kind of graduate into some of these tax equity transactions. And I think we view them as many times having higher returns for similar or even lower risk. And because of the kind of unavailability of tax equity in the market, you tend to have a lot of negotiating power as a tax equity investor. So sometimes you're able to get higher quality deals, better terms, better counterparties. So I see us, both continuing the current business of transfer credits and hybrid transactions, but also, continuing to bring new investors into the tax equity market. And, I think that will be necessary to keep up kind of the growth rate that the industry has been seeing over the last few years.
Great. Thanks, Bryen. That's a great note to close on. And tax insurance really has become a more indispensable part of how these deals get done. And I think we've touched on here, the post-OBBB environment makes tax insurance more relevant, not less. And so I wanted to thank Bryen, Jordan, Yoni for the conversation today. This was really strong and far more in-depth than even I was expecting. I wanted to thank everybody for tuning in to Foss Company's Tax Credits Today. And please make sure to subscribe for future episodes. If you have any questions, please reach out to us. We'll be sure to share contact information and look forward to working together on deals in the future. Gentlemen, thanks for joining me today and looking forward to the next one.
This webinar is presented by Foss Company, featuring CAC Specialty. Foss Company and CAC Specialty have a prior working relationship and may have financial interests in the products and services discussed in this webinar. Viewers should consider this when evaluating the information presented. Securities offered through Orchard Securities LLC, member FINRA SIPC. Foss Company is not affiliated with Orchard Securities LLC, nor is it a broker-dealer. Foss Company and Orchard Securities LLC, member FINRA SIPC, does not provide tax or legal advice. CAC Specialty is an independent third party, is not affiliated with Orchard Securities LLC or Foss Company. This webinar is presented for informational and educational purposes only. Nothing contained in this presentation constitutes or should it be construed as tax advice, legal advice, investment advice, or a recommendation to buy, sell, or hold any investments or insurance products. The information presented reflects the views and opinions of the presenters as of the date of this webinar. It is subject to change without notice as legislation, IRS guidance, and market conditions evolve. Tax credit investments involve significant risks, including illiquidity, loss of principal, project failure, and recapture of credits previously claimed. Tax benefits depend on each investor's individual tax situation and are subject to change by legislation or IRS guidance. The One Big Beautiful Bill has materially altered the availability in terms of certain tax credit programs, and further changes may occur. There is no secondary market for tax credit investments, and investors should be prepared to hold for the full investment duration. Past performance is not indicative of future results. This is not an offer to sell or a solicitation to buy any security or investment product. Viewers and attendees should consult with their own qualified tax counsel, legal counsel, and financial advisors before making an investment or tax decision.